Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a different subject from the world of investment and attempt to apply the lessons as laid down by the man widely considered to be the father of the craft, teacher and mentor to Warren Buffett no less. We're of course talking about Benjamin Graham. In this episode, we should be looking at yet another important principle when it comes to successfully applying the art of value investment to your portfolio. Today, we should be considering the importance of staying inside your circle of competence as an investor. In other words, only investing in those businesses that are understandable and understood by the person doing the investing. Throughout the episode, we shall see what we mean by that in practical terms, consider the risks of leaving this circle, and the reasons why, if we don't understand it, we shouldn't be doing it. So let's get right down to it. Sit back, tune in, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. Now, the subject that we're going to be talking about today, from one point of view, is obvious enough. If we're considering whether to invest in some business or another, then the very first thing we should be asking ourselves, before we waste our time with any in-depth analysis, is the very simple question: is this business understandable to me? And if the answer to that question is clearly no, then the investor will do best to quickly move on to the next opportunity. But frequently, investors, even experienced value investors, can fall into the trap of tricking themselves into believing that a business is so cheap that their inability to know what is really going on under the hood is just a minor triviality. If some business person was considering for purchase some private enterprise, they would, I'm certain, be quite insistent that the business was in their scope of understanding, for their inability to understand it will inevitably mean they are highly unlikely to be able to place a value upon it. Yet far too often, these same business people, when investing their money instead in the stock market, allow this line of reasoning to fade away with the light. So let's first start with the good news. The vast majority of businesses listed on the stock markets are in actual fact pretty simple entities that can be understood well enough by most. Regardless of how complicated or simple their product or service is, an assessment of the financials can usually shed light on what that business is worth in dollars and cents. It doesn't matter if the product is pig's wheel or iPhones. Revenue is revenue, profits are profits, assets are assets. And the person on the street can usually determine, through consideration of the quantitative and qualitative showing, what that particular business deserves to be selling at. Not always, but usually. But there are certain businesses that I maintain are impenetrable to the lay investor. So impenetrable as to make a reasonable assessment of valuation impossible. Let's start with the financial institutions. The only person I believe who is reasonably going to make any sense of a bank's accounts is a banker. They're simply too complicated for the average investor to get their head around. I did actually once make the effort to understand what the LIBOR rate was, for instance, but it was so boring, I forgot. And if you don't understand the LIBOR rate, derivatives and all the other alien terms that you will find in the annual accounts of any banking establishment, then what gives anyone the confidence to think they can place a value on the bank as a complete entity? It can't be done. Likewise, insurance companies. Unless you fully understand things like risk premiums and all the other financial intricacies that make up this type of business's stock in trade, then how can you possibly hope to know what price to pay for it? Now, as a brief aside, I will point out here that some of Warren Buffett's and Berkshire Hathaway's most profitable ventures over the years have been with insurance companies. There's been Geico and plenty of others. Indeed, I think the last time I looked, I think it makes up the single largest segment of Berkshire's portfolio, revenue-wise. The fact is that insurers are incredibly attractive businesses. This is because of the gap between receiving premiums from customers and having to pay out claims. This creates a significant pot of money that the business is free to invest, and when someone like Warren Buffett can routinely achieve annual rates of return of 20%, at least historically, you can see why insurance has been such a goldmine for him. But here is the thing, Buffett understands very well how the industry operates, and how to interpret and evaluate the facts and figures. Not only this, but he's always made sure to surround himself with experts in the field, such as Ajit Jain and Todd Coombs. This has allowed Buffett and Berkshire to invest confidently in insurance companies. But this very specific and detailed know-how is not an expertise that is likely to be shared by the average investor. Therefore, how can he be expected to be judge and jury on any insurer's attractive merits and convert that knowledge into what price to pay for its stock? To me, the financial institutions are the obvious ones that are going to sit well outside the average investor's circle of competence. But these are not the only ones that are likely to prove well beyond comprehension from the standpoint of valuation. Any business where you cannot or do not understand the product or service well enough can be grounds to place it outside of that circle. So for me, at the moment, that would be all the AI businesses out there. I mean, it's kind of irrelevant currently anyway, because these businesses are well outside the scope of value. But even if they weren't, I don't understand the product well enough to place a valuation upon it. I of course get AI on a very basic level, but I've not studied it enough to understand where these revenues are coming from now, and more importantly, will do in the future. It is therefore de facto outside my circle of competence. And whilst the financial accounts are a lot more comprehensible than that of the financial institutions, in this case the problem comes not with the financials, but what to me is the abstract concept of artificial intelligence. Warren Buffett once said the test of whether you understand an idea is if you can express it to others in a way that they can understand it. And for me, that rules out AI straight away. But this is not to say that a business that is currently outside that circle will remain so forever. Rewind perhaps 20 years, and a business like Alphabet, or Google as it was back then, would have been far outside my circle. But now it seems companies like Google are pretty simple businesses doing pretty run-of-the-mill things. But back then to me it was new, and I wasn't quite sure what it was doing or where it was going. Exactly the same thing can be said for Apple or Meta back then. But now I think that most of these businesses have come into my circle, and I feel confident placing a value upon them. So of course, perhaps in 20 years' time, those AI companies will enter that circle when it becomes apparent to me what the hell is going on. But the fact that there will always be certain businesses that are outside my scope of understanding needn't be any real drama or cause for concern. In an ideal world, I would love to invest in insurance companies in particular, because they have such an attractive business model. But the fact is that the vast majority of businesses out there are quite understandable to me. Businesses where there's nothing in the accounts that are impenetrable to the layperson, that offer products and services that may or may not be complex, but where I can perfectly well understand where the revenue is coming from. So there really is no need to beat ourselves up that a handful of businesses remain out of bounds. The real risk lies in convincing ourselves that we are qualified to an opinion when we are not. Equally, when things like banking stocks intuitively feel underpriced from time to time, the risk is we invest with our heart and not our head. We can trick ourselves into thinking, because we deal with financial accounts day in and day out, that they are always an equal and an equivalent, forgetting if we don't understand where this money has come from, or where it will come from in the future, then this fact completely invalidates our calculations. To invest in something you do not understand, that is outside of your circle of competence, is to invest blindly. One of my all-time favourite fictional businesses appeared in the movie Austin Powers. It was called Verticon, which we're told owns factories that makes miniature models of factories. Now there's a business you can really understand and get under the hood of. And if you stick to these types of businesses, whilst employing all the central tenets of value investment, the chances are you'll do all right. And that's all for today's edition. I do hope you've enjoyed considering the merits of strictly staying within your own circle of competence. By being honest with yourself about what you do and what you do not understand will prevent you from falling into the trap of placing erroneous valuations on businesses based on financial data that is made foul by your own ignorance, to put it bluntly. If you have enjoyed it, you know what you can do. Please add to playlist so that you'll be alerted as soon as any new additions land on your platform. And please do continue to spread the word. It really does make a huge difference and will allow us to become as large a community of like-minded investors as is possible. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.